Hey everybody, welcome back to the Peak Financial Planning YouTube channel. In today's video, we're going to be looking at one of many retirement risks, specifically called sequence of returns risk. So sequence of returns risk is one of the greatest threats a pre-retiree or early retiree is going to face. Specifically, it's most important to pay attention to during a phase in your life that we'll call the retirement risk zone. So in today's video, I'm going to do my best to explain these concepts so that you understand just how important it is to plan for sequence of returns risk. And then I'm going to share some strategies for how to deal with them. All right, sequence of return risk is the risk of poor market performance right before or as you enter retirement. This is a particularly bad time for your portfolio to take a hit because you're going to be close to the point of taking distributions from your investment portfolio. This period of time in your life is called the retirement risk zone, which is the first 5 years leading up to your retirement and then the first 5 years in your retirement. And the reason that this period of time is of such consequence is that if you have negative market returns, your portfolio may not have enough time to recover from downturns before you start taking withdrawals from it. What ends up happening is if your portfolio is below your target value as you retire, and then you also take distributions from it, you end up depleting the portfolio too quickly and potentially run out of money. So I'm going to show you an example of this in just a few minutes here, but I want to address one more particularly nefarious item that we have to pay attention to as we're exploring sequence of return risk. By the way, if you're here watching this video, it's probably because you're retiring soon or planning ahead for retirement. Clearly, you're taking your finances seriously. So if that's the case, I have a free masterclass training video that you should watch in addition to this one. And in that masterclass, I detail the top strategy retirees are using to increase their retirement income and avoid running out of money. You can watch the video for free by going to app.thepeakfp.com/free training. All right, so let's carry on by talking about that sneaky detail that I mentioned that is specifically using average rates of return when making a retirement plan. So in the investment advising industry, we rely a lot on average rates of return over a period of time, but that can be a big problem because using average rates does not allow us to be timing specific. For example, you could have two 15-year periods with the exact same average rate of return, but if you start taking distributions from a portfolio in year one, you end up with a significantly lower ending portfolio value than if you start taking distributions in, say, year 5. So let's take a look at an example of this in real time. All right, so we're going to take a look at a couple examples of sequence of returns risk with numbers. I'm going to try to keep this simple. I know there's a lot of numbers on the screen in front of you. Let's go through the two different scenarios. On the left here in green, we have someone who retires at the beginning of a down market. That means the first years of the retirement are negative market returns. And in blue here, we're going to have someone who retires at the beginning of an up market. Both portfolios are going to have a starting investment value of $500,000. And they're going to have a flat withdrawal amount over the 15-year period that this exercise takes place in of $20,000. So we're holding things constant. And the only thing we're trying to illustrate with this example is the difference in ending portfolio value of the two portfolios, which have the same average rate of return over that 15-year period. The only difference is that the negative returns in the green side happen at the beginning, and the negative returns on the blue side happen at the end of the 15-year period. And you can see that down here, this is your ending portfolio value. Someone who has negative sequence of returns at the beginning of their retirement will end up with a portfolio value of $355,000 after 15 years of taking $20,000 distributions. In the blue side, someone who has who ends up taking the same withdrawals but has all positive returns at the beginning and their negative returns at the end ends up with $603,000 of ending portfolio value, same average rate of return. But what you can see here is that the investor in blue has $250,000 more than the investor in green because of the timing of those sequence of negative returns. Okay, so this scenario holds withdrawals constant. What happens if we use different strategies to try to mitigate that? So we'll go over to a second scenario here, and this one shows what's called the 4% rule, which is what's considered the safe withdrawal rate. So in this scenario, you have the same $500,000 initial portfolio value, same sequence of returns. In the green side, it's negative for the first 5 years and positive for the remaining 10. And on the blue side, it's positive for the first 10 and negative for the remaining 5. And you can see here that if we use a 4% withdrawal rate, which is 4% of last year's ending portfolio balance, and we use that each year to determine our withdrawal amount, that at the end of 15 years, the two portfolios have the same ending value, the same average rate of return, but here the major difference is that the blue portfolio ends up having $410,000 of possible distributions, while the green portfolio only has $220,000 of distributions. So you can see here, both scenarios have the same average return, but in this scenario, they both have the same ending balance, but investor blue was able to withdraw almost $185,000 more than an investor in green because of the timing of those sequence of returns. Now, this 4% rule preserves the portfolio value so that at the end of that 15-year period, you still have money, the same amount of money. But what it does is it limits your spending each year. And so if you were going to need to rely on a specific target amount of income to draw from the portfolio, and that 4% rule limits you from that, you're going to need to make up that income gap somehow. And later on in this video, we'll talk about different ways to address that. But for now, it's important to note that this strategy preserves the portfolio value, but it limits the amount of income you can draw. And so there might be a current year income gap that you'll have to solve for. All right, so now let's look at a third scenario, which is, let's say we want to actually just draw the same amount of income from the blue portfolio and the green portfolio, regardless of market returns. So in this blue portfolio, we have a $500,000 starting value, same sequence of returns, meaning the negative returns are at the end of the 15-year period. And we want to withdraw $410,000 because that's the 4% safe withdrawal rate. Let's say we want to withdraw the same $410,000 from the green portfolio, but in the green portfolio, we have negative sequence of returns in that first 5 years. What you'll see here is that same withdrawal amount, same average rate of return, but in the green portfolio, you have an ending account balance of $160,000 compared to an ending in the blue portfolio of $505,000. That's a $345,000 lower ending portfolio balance at the end of 15 years. So I just show this for the purpose of illustrating how impactful sequence of returns risk can be when you're either just entering retirement or in the years leading up to retirement. It's really, really important to consider that the idea of a 4%, or sorry, the idea of an average rate of return can be extremely misleading because all these portfolios and all these three scenarios that I show have the same average rate of return over 15 years. But the timing really, really matters. And yeah, I hope this exercise was helpful. We're going to jump back to the main video in here in just a sec. See you in a second. All right, so now you've seen a few scenarios that show the dangers of relying on average rates of return combined with poor sequence of returns immediately upon retiring. And so the question now is, what can we do to protect ourselves against these risks? So there are really three ways to protect yourself against sequence of return risk. We've already covered the first, which is having a plan to adjust spending in retirement so that the portfolio is not depleted too quickly. And that would be using something like the 4% rule or a dynamic spending rule. The 4% rule was illustrated in the second slide we just looked at on the Excel sheet. You can zoom back and go take a look at it again. But what the 4% rule does help us preserve our portfolio value. It also requires spending less in retirement. And you may recall from the example that the investor who retires at the beginning of a poor sequence of returns was able to end up at year 15 with the same ending portfolio value, but had to choose to withdraw around $185,000 less than the scenario where the portfolio was going up at the beginning of an up market. And that's a huge difference. So it's important to note that while the 4% rule does preserve your portfolio, but if you were going to be relying on a specific amount of income from the portfolio, then that strategy is going to require you to make up for the income gap in some other way. And so this leads to the second and third strategies that can help manage sequence of returns risk. The second strategy is to adjust your retirement date or go back to work. So going back to work allows you to stem the bleeding, so to speak, because you can halt withdrawals from the portfolio and then make up any income gap through employment. This buys your portfolio time to recover from the series of bad market returns that happened right before starting withdrawals. So if you can halt withdrawals, you can minimize the damage to your investment portfolio because negative market returns and withdrawals combined are like a 1-2 punch that accelerate the depletion of your investment account. Now, if you're not retired yet, but are planning to retire in a year or two and have had a series of poor market returns, something like 2022 is a good example of this, then exploring whether you can delay retirement can be extremely impactful. In fact, a study performed by Stanford Institute for Economic Policy Research showed that each additional month working and delaying retirement had the same effect as saving 1% of your salary for 10 years. And that's because by working longer, you shorten your retirement period, delay distributions, continue saving, continue to accrue increasing social security benefits if you're under age 67, continue to accrue increasing pension benefits if you have one, and then continue to provide time for your investments to grow if the market has positive returns. All right, last but not least, you can also plan for sequence of returns risk using a portfolio allocation strategy called the bucket strategy. The bucket strategy divides retirement into distinct time increments that allow investors to choose investments that deliver specific outcomes at specific times. So assuming 30 years of retirement, an investor might divide their retirement assets into 3 stages. Stage 1 might be the first 10 years of your retirement, and the assets needed for that shorter term bucket are invested into investments that are lower risk and easily converted to cash, things like laddered bonds, treasury inflation protected securities, bond funds, maybe even cash and cash alternatives. This mitigates the risk that a poor sequence of returns seriously depletes the first bucket and leaves you without adequate funds to live on. And now you'd move to stage 2, which is the middle 10 years of your retirement. The assets needed for that second stage can be invested into things that are slightly riskier, things like bonds, maybe some equities positioned for growth, maybe even commodities and real estate. More risk can be taken here because you, the investor, have a longer time frame to ride out market swings. And then you have stage 3, which are the final 10 years of retirement, and those assets are needed for the last part of your retirement, and you can support the most risk with that basket. The investments in the third stage might include small cap stocks, emerging market stocks, high yield bonds. The longer time horizon that you have here for this third bucket gives you more time for the portfolio to recover before the assets in that bucket are needed. So as you, the investor, move from stage 1 to stage 2 and then eventually stage 3, each bucket's investment allocation is going to be adjusted so that the funds needed on a shorter time frame move to more conservative investments. And studies have shown that this more active approach to managing a retiree's investments protects against downside risk in retirement presented by sequence of return risk, but also can help with investor anxiety. So anyway, I hope this video on sequence of returns risk and the retirement risk zone was helpful. If you need any assistance in planning for these things, you can reach out on our website at peakfinancialplanning.com. Also happy to take a deeper dive into any of these subjects if you so choose. You can leave information or questions in the comments section on this YouTube video below, and we'll be happy to address them. And then last of all, thank you for your time and attention. I really appreciate your support, and I look forward to next week's video.